You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Hey, happy Halloween, Jim.
Well, some scary stuff out there. Ooh, I'm very scared. You're saying right now China's debt very similar to Canada, and we're kind of importing their problems.
Well, you know, the commodities demand cycle that drove so much of Canadian revenue and growth in the past, you know, since say 2001, when China joined the World Trade Organization, and we had, you know, the free money policies of the Fed and the U.S. Cutting rates after 9/11, and you had all the subprime mortgage fiasco. All that consumption really drove two countries exceptionally well, and one of them was Canada and our resource demand, which was fueled into developing markets like emerging economies where they were fabricating things out of raw goods that were being produced by countries like Canada and Russia and, you know, Australia. So it drove the GDP of those export countries, as well as, you know, the output of finished products from China, but it was all being demanded by a West that was abusing credit. So once the bubble burst in 2008, then you had to be concerned about the mean reversion phase, let's put it that way. And so we saw that everything came to a standstill in 2008, a recession. All things were coupled, everything went down hard, and then rallied strong out of the bottom in early 2009 because of all these, you know, different easing stimulus programs that were concertedly exerted at the same time all over. So China did a massive one that was even larger in scale, relative scale, than the U.S.'s stimulative programs out of the central bank. And so you got that reflation trade, really dramatic, quick pop off the bottom in 2009. Well, you know, global growth really peaked again in 2010, Jim. And all the charts we were looking at said, okay, so we've got a lift off the bottom in 2009. And then sometime in 10, you know, the world economy started to sputter again. Demand was sort of weak, and that's when the central banks came out with more stimulus, right? And it was that decoupling that took place from the tranches of stimulus, you know, Q1, 2, 3, ever, all that stuff. You saw asset prices in a lot of different genres go through the roof, and yet the growth wasn't picking up. And then that's when we saw the turn down again in the things the world uses, like commodities. So, you know, a lot of commodities re-peaked in 11. We saw the same thing with a lot of the global PMI data, a lot of the, you know, precious metals, everything really revamped into 11 and then sold off since. And emerging markets did the same thing. So everywhere you looked, you saw evidence that the growth cycle had turned already, and yet you saw certain assets inflating on the liquidity that was in the system. So Canadian real estate's been on fire, you know, certainly in hot zones like Vancouver and Toronto in the West. A lot of people believe the commodity story had just entered another fresh leg rather than, you know, had already peaked. And a lot of companies were still doubling down on expanding their capacity for output and, you know, investing in a bunch of machines and people. And now what you've got is a really abrupt reversal of those trends, Jim. So, you know, oil that was 115 as early as June is now down to 80 again. We're seeing, you know, gold and silver back to where they had, where they were late in the in 2009. The venture exchange is back where it was in 2009. So to me, it is just it's a very connected, coupled story. I know people like to talk about decoupling and which assets and markets should do well when other developed markets do poorly. I'm afraid we're highly coupled in this environment. So, you know, the Canadian real estate story and the commodity story were what drove Canadians to be voracious consumers of debt in the past few years. It was an excess confidence that we were different, or that, you know, because we sold commodities, we were in this sort of basking in endless cash flow. Well, that hasn't been the case. And all the budgets that were set by governments around the country, in the main growth areas in Canada, as you know, have been in the West and in Newfoundland, Labrador, all this commodity story. Well, with the plunge from, 147 on crude in the peak of '08 to around 80 today, a lot of revenue bases have assumed that we'd be back at oil prices in the $97 range per barrel. And so you look at things like the national budget. The Conservatives have an assumption of a fiscal surplus this tax year. But now that drop in oil has happened since June, that entire $3 billion they thought was sort of excess funds has evaporated. And they're still hoping to give tax cuts as they've promised them before the 2015 election. But I'm just looking at the math going rapidly the other way and saying, so now we're into deficits again mounting, and are we really going to give people tax cuts in this environment? I just think that Canada has really missed out on the macro trend here and has, really put themselves as a country, put ourselves in a vulnerable position, because if this is a secular peak that was achieved in the commodity cycle in 2011, that means we got about a decade here of working off the excess inventory, the excess production, the downsizing of all the projects that were slated when they were factoring in these higher costs, higher prices. And that's when a domestic economy is supposed to have some savings built up in it so people can, get through a slower growth period. Well, guess what? We have not planned for this rainy day, not on any level, not corporate, not, households, certainly not government, and definitely our financial institutions are not in great shape to absorb any sort of significant losses. So I'm a little concerned, to say the least.
Yes, the BC government putting on a brave face after one of the major players in liquefied natural gas said, yeah, we still plan to develop in BC, but not for another decade now.
Mm-hmm. Well, this is what you're seeing, even the dynamics, it makes perfect sense. So the exuberance that went on in China, they stockpiled a ton of stuff thinking that the West would be back to its spendthrift ways any day now. And what happened is, their demographics peaked in 2011 as well. So they're having, first of all, it was this story that everyone had bought about the idea of farmers migrating into the cities and urban development being the thing driving Chinese demand the past few years. But actually, it was an upgrade demand more than an urbanization demand. In other words, people that are living in cities had been living in really poor conditions. And with the stimulus that came into the financial sector over the past few years, when the bubble burst in the rest of the world and China turned to its domestic banks and said, here, go find people to borrow money, do anything you can, let's prop up the real estate, market and get lots of stuff built. Well, now they've got such excess inventory, and people have already upgraded in the cities, and now you've got the demographics turning down, and it's going to be at least a decade now of falling growth in the realty market. They don't need any new supply for at least 10 years. So just soaking that up is this kind of a slowing force year over year. It's not like it's a blip. It's not like a 1-year transition. It's probably a decade. And the same goes for, as I was reading that about China, I was thinking, geez, that's what we've done in Canada, where everybody upgraded everything they had because, you could, because money was cheap and cash flow was flowing, and everyone believed that the commodities thing was just a quick, was about to come back at any moment. And of course now you're having layoffs and downsizing. You're seeing the mining materials sector starting to liquidate equipment. All that equipment that Caterpillar was selling to the world, in the boom cycle, and Caterpillar's earnings and sales have been falling for the last several years now. Well, tons of equipment now on the market, and everybody's starting to get a cash crunch and wanting to sell it. They're going to start cutting workforce again. It's not just Tim Hortons that's likely to be downsized in the next little while, and it goes back to how resilient is your workforce in terms of how much savings do they have and how much debt do they have? How will they be able to get through a period where unemployment picks up again? And I think the answer is we're the least prepared we've ever been, certainly in my lifetime, going into any kind of a recession that I'm aware of. We're the least prepared today. We're the most vulnerable. So it doesn't make you feel great. And then I get anecdotal reports from various places in the West where the housing market was on fire. And, they're reporting, certainly in the past few months, it's become a buyer's market again because there's less people looking to, quote, trade up or come into the area. In fact, the exodus of population is starting to go back the other way, and they come to the east, and guess what? We haven't had a great job growth in the east for the past several years. So it's not an easy, I can't quickly see this resolving itself. It's not like a little blip. I think it's a more drawn-out affair.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Danielle Park, editor of the popular blog Juggling Dynamite. Danielle, with a downturn expected, is there any place where you can put your money where at least you can hold on to it, if not make money?
Well, yeah, it sounds really boring, but the high quality investment grade bonds are not too long out, short term, provincial and state issues have been actually going up in value through this period. I am concerned about corporate debt because there's been a ton of it issued at very low rates, which is priced for absolute perfection. And whenever you start to see, a liquidity crunch come where people start having to raise cash like I was describing, you see corporations having to sell assets, and there's an exodus to try and sell some of the corporate debt people have bought at unreasonable prices the last few years. So I think you could see a crunch there. So I don't like the corporate debt cycle. It tends to follow the equity cycle. So both are kind of vulnerable at this point. But I do like, as I say, the investment grade, highest quality deposits and U.S. dollars. Jim, we've been talking about U.S. dollars, but the U.S. dollars through 86 today, U.S. dollar index, Canadian dollar continuing to weaken, which again makes sense when you consider the dynamics we've just finished discussing, and a weaker Canadian dollar continuing for a while here. So it's kind of like what we saw in the last '08 recession where, high quality bonds and and U.S. dollars appreciated while everything else fell together. But that's where you were able to maintain your liquidity and some purchasing power. Canadian TSX 61% focused on energy and financials today, Jim. Not a great diversified basket of things, as many people would lead you to believe, when you have that kind of over-concentration in the two sectors that are still, pretty pricey. So, it's more an art of knowing not what to buy in this environment than it is knowing what to buy. Keeping things liquid and simple is really the strategy that I've found the most useful in these environments over the past 15 years. Now you'll get a buying opportunity again, just as we did in '03 and just as we did in '09. It could come, it's very difficult to say. It could take weeks and it could take several months. But typically, if things really did peak in June, a bear market typically takes 9 to 24 months to complete. So this one could either go extremely quickly, or it could be, a more drawn out, where you get a leg down and then some rally for, a number of weeks, and then the next leg down. And we know that those who could buy have largely bought and been fully allocated, more than 100% invested. In other words, have borrowed to invest on top of putting whatever cash they had to work in the past couple of years. The whole QE belief phase, I think, will prove to be one of the most dangerous things that ever hit, because the central banks have been jawboning everybody and assuring that they're magical. And I think what you're going to see is that they've just spent everything that they normally could throw at a downturn to truncate it. Now they have nothing left except, jawboning and words. They don't have any rate cuts left to deliver. The Fed's wrapped up its QE as of this week. And, they may indeed pull out another round of that, but if they do that too quickly, I think you're going to see people really have the opposite effect of confidence, because they're going to realize that it's just a game and that it hasn't worked. And you even got Alan Greenspan this week, which is, certainly I consider one of the architects of this disastrous phase when he began his easy money policies in the 80s. He's now on his, got a soft copy out of his latest book, and he's talking about how QE hasn't helped the real economy. So, when you've got the master of disaster admitting the truth, at some point you're going to run to the end of that confidence narrative, and it's going to be a question of where values really lie, where investment opportunity makes sense and where prices need to come back to. And as I say, when I look at everything that leads the global economy, and that's actual demand, that's actual cash available, that's, debt levels, which are now, emerging market debt today, Jim, is 36% higher than it was in the '08 crisis. Overall, the world's debt to GDP has gone above 200% in the past 6 years. So we're in much more levered, dangerous territory coming into this downturn than we were in any of the ones, as I say, in my living recollection. So I think this could be the final washout of the secular bear. We've been working at it now for about 17 years to get to the end of this period, and typically it's 17 to 20 years. So we got a lot of downside action here to accomplish in order to complete the secular bear. But when it does complete, you're going to have wonderful opportunities for cash. And I am encouraged, because it's not, as I say, I don't think we're that much further to go here to get through. It was learning that QE was nonsense, and that governments, that central banks were just making it up as they went along. Once you get to that point, then you realize there's no Santa Claus, there's no magic, there's no fairies left to come,
We'll have to rely on the great pumpkin.
Great.
Danielle, thank you a lot for talking to us.
Okay, my pleasure.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, and check out her podcast, Not So Common Sense. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. We're also up on YouTube. You can forward comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.